Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. Fed Chair Powell just handed markets the clearest signal yet that the cutting cycle begins in September. The July 29, 2026 Federal Open Market Committee meeting held rates steady, but the language and tone from Powell's post-meeting remarks are driving massive repricing across every asset class. Let's decode what this means for your positions right now. The Fed kept the policy rate unchanged at its July meeting. Sources report the range held between 5.25 and 5.50%, with the decision unanimous or near unanimous, though a few dissenters actually voted for a 25 basis point hike. But here's what matters. Powell deliberately avoided calling this a pause. According to the MUFG recap, he framed it as a period of watchful thinking and emphasized that market participants are learning to play the ball, not the referee. That phrasing is critical. It tells traders the Fed is setting up the board for a dovish move without committing prematurely. Powell's Jackson Hole speech and subsequent comments made the pivot explicit. As reported by Reuters and Investopedia, he stated the time has come to adjust policy stance if incoming data warrants it. Translation: the September meeting is live for a cut. CME FedWatch probabilities surged above 90% for a September rate reduction immediately following these remarks. One analyst quoted in Yahoo Finance said Powell's speech made it clear there are likely a series of rate cuts on the way, and if conditions deteriorate, even a 50 basis point cut is on the table. Why is this happening now? Inflation remains above the Fed's 2% target, but the emphasis has shifted to the labor market and growth risks. Powell signaled that if the August jobs report shows sufficient weakness, the committee will act. This is a fundamental recalibration in Fed priorities, moving from inflation vigilance to employment protection and growth support. The dual mandate is rebalancing in real time. Now let's talk bonds. Treasury markets repriced aggressively post-Powell. The 10-year yield dropped approximately 7.5 basis points to around 4.08%, while the 2-year fell roughly 10 basis points, according to reports from CNBC and the Wall Street Journal. These aren't minor technical adjustments. This is the market revising its entire rate path for the next 12 months. Duration risk just became more attractive, and the yield curve is showing early signs of steepening as front-end cuts get priced in while longer maturities adjust more slowly. Traders watching technical breakpoints should note that the 10-year retesting the 4% handle is significant. If yields continue compressing, we could see a rush into longer duration treasuries as investors lock in current levels ahead of multiple cuts. The 2-year, more sensitive to near-term policy, is already reflecting 90% plus odds of September action. This creates opportunity in the curve for those positioning ahead of the official announcement. Fixed income isn't the only game reacting. Equity markets are rotating hard. Defensive mega-cap technology stocks have held safe haven status through uncertainty, but cyclical value plays are gaining traction. Why? Lower rates mean reduced borrowing costs, improved corporate margins, and unlocked capital expenditure for economically sensitive sectors. According to analysis from RSM and Eastspring Investments, the rate cut cycle historically favors cyclicals over defensives as liquidity conditions improve and growth expectations stabilize. Tech earnings have been robust, supporting recent market highs. But the forward-looking trade is shifting. Industrials, materials, consumer discretionary, and financials are seeing increased positioning as traders anticipate a Fed-driven margin recovery. If you're overweight defensive tech without cyclical exposure, you're potentially missing the rotation trade of the second half of 2026. Energy and materials specifically benefit from lower financing costs and infrastructure spending that accelerates in a lower rate environment. Small cap and mid cap stocks, which are more levered to domestic growth and borrowing costs, also stand to outperform if the Fed delivers a sustained easing cycle. The Russell 2000 has already shown responsiveness to dovish Fed signals, and if cuts materialize as expected, we could see significant catch-up relative to large cap indices. Crypto markets are positioning for liquidity expansion. Digital asset traders interpret Fed rate cuts as a precursor to broader monetary easing and balance sheet expansion down the road. Bitcoin, Ethereum, and altcoins are risk assets that thrive in high liquidity environments. As reported across crypto-focused outlets, inflows into digital assets have picked up in anticipation of dovish policy, with traders front-running the official pivot. Here's the connection. When the Fed cuts rates, real yields compress, making non-yielding assets like gold and Bitcoin relatively more attractive. Additionally, lower rates reduce the opportunity cost of holding risk assets versus cash or short-term treasuries. If Powell delivers on the implied September cut, expect continued inflows into crypto, particularly if institutional participation accelerates through Bitcoin and Ethereum exchange-traded funds. Now, what are the key risks? Powell's language was deliberately ambiguous to preserve optionality. If the August jobs report comes in stronger than expected, or if inflation data surprises to the upside, the Fed could delay. The phrase watchful thinking leaves room for the committee to hold again in September without losing credibility. Markets are pricing 90% plus odds, but that also means there's a 10% tail risk of disappointment that could trigger violent repricing. Another risk, the size and pace of cuts. A 25 basis point cut is the base case, but some analysts have been floating the possibility of 50 basis points if data weakens materially. While a larger cut might seem bullish for risk assets, it could also signal that the Fed sees greater economic vulnerability than markets currently price. That could spook equities even as bonds rally. Geopolitical and fiscal factors also matter. If fiscal stimulus or geopolitical events create inflationary pressures later in 2026, the Fed's cutting cycle could be shorter and shallower than currently expected. Markets are pricing a multi-cut cycle, but if inflation reaccelerates, we could see a quick reversal in policy expectations, similar to prior cycles where premature easing led to renewed tightening. Let's tie this together tactically. For bond traders, the move is positioning in the front and middle of the curve ahead of confirmed cuts. 2-year and 5-year treasuries offer attractive entry points if you expect multiple cuts through year-end. The 10-year is more sensitive to long-term growth and inflation expectations, so watch for steepening opportunities if the curve adjusts unevenly. For equity traders, sector rotation is the trade. Reduce overweight positions in defensive mega-cap tech that have priced in safe haven premiums, and add exposure to cyclicals, small caps, and value names that benefit directly from lower rates and improved credit conditions. Industrials, financials, consumer discretionary, and materials are the sectors to watch. Monitor earnings guidance closely as management teams will adjust capex and margin outlooks based on the new rate environment. For crypto traders, the setup is constructive but contingent on follow-through. If September delivers the cut markets expect, Bitcoin and Ethereum should see sustained inflows. Watch stablecoin supply, exchange balances, and institutional ETF flows as leading indicators. If liquidity conditions improve as anticipated, digital assets are positioned to outperform traditional risk assets on a relative basis. The broader macro picture, Powell's pivot marks a significant inflection point. We're transitioning from a tightening regime focused on inflation control to an easing regime focused on growth and employment support. This shift has profound implications across asset classes. It changes the risk-reward calculus for duration, sector allocation, and alternative assets. It also sets the stage for potential volatility if data doesn't cooperate or if the Fed's communication creates confusion. Bottom line, the July hold was a tactical pause, not a policy endpoint. Powell's messaging, the 90% plus September cut odds, and the immediate repricing in treasuries and equities all confirm that the cutting cycle is imminent. Position accordingly, monitor the August jobs report closely, and prepare for a fundamentally different rate environment in the second half of 2026. The Powell pivot is here, and it's driving rotation, repricing, and opportunity across markets. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.